Hey guys, Heirloom clients and friends and family. We are starting this video podcast. Mike and I are here today. Probably be us most of the time. Have some other advisors in occasionally, but the point of this is to get you guys content on what's happening at the portfolio level, at the economy level, things that we're talking about frequently, on a more frequent basis than the newsletter that Mike puts together. Every 3 months or so. So this is hopefully an every other week kind of thing for y'all. It will be on the YouTube channel as you are currently viewing it now. If you just want to hit subscribe to this channel, we're going to have these longer version what's going on videos, as well as what we'll talk about today, like what is a bond, little snippets out there for you as well. So a little shorter, condensed topics that we're frequently talking about at the time, or constantly talk about, and then just longer free flow. Mike and I just talking about kind of what we would talk to you about if you were sitting here. So we just have a chance to talk to you a little bit more frequently about what's going on. So yeah, subscribe. You'll get an alert when we upload a new video. We'll also give you guys until we grow that into a little bit of a larger content library. We'll send it out to you as well. But this will be how we primarily get out, the more frequent happenings of what we're talking about. So without further ado, you all know Mike Houston. I am Rick Hurley, if you are not a client. We are the principals of Heirloom. And today we are going to talk about all things current. So we've heard a lot about rising rates, or at the end today, as of, what is today? The 2nd of August, the Finch ratings of the U.S., causing some volatility in the markets today. Talk a little about portfolio positions and yields, and then what the heck's going on with the stock market run, and if we can expect to keep it going. So to really preface all that, and to really give you the first snippet that we'll talk about, we've talked to most of y'all, at least at some point. We'll give you a refresher here on what the heck is a bond. On the high level, a bond is just an IOU. It can be from the Treasury, the Fed, a municipality, a corporation. But it is them saying, hey, we need some money and we're going to pay you back a certain interest rate for you giving us and letting us borrow your money. Mike's got some great metaphors on this, but, add some color to what the heck is a bond for us, Mike, and why they are so important in your portfolio and generally.
Yeah, I think bonds are, it's important to understand fundamentally what it is. And, at its core, a stock is a fractional share ownership of a business. Most people understand that. Makes sense. You're entitled to the profits of the company, and, over the long term, the company grows, you'll make more profit. A bond is a fractional interest in part of a loan. To your point, the bond could be issued by the United States government. Those are commonly described as treasury bonds, treasury bills. Municipalities issue bonds to raise funds for projects, from new stadiums to, fixing sewers or whatever it happens to be. Corporations issue bonds. Those are typically, Pepsi wants to build a bottling plant. They go to the public and say, hey, we need $50 million to build this plant. Rather than using their internal capital, they'll tap the bond market and, say, hey, if you give us $50 million to the general public, we will pay you 5% interest over the next 10 years, whatever the term happens to be. At the end of the 10-year time frame, we'll give you your principal back. And so whereas a stock is a fractional share of ownership of the business, we have a lot of uncertainty around what's going to happen with that business, the growth. Hopefully the market cooperates, the business does well, and we make a profit through capital appreciation, dividends. The cash flows are a little bit less certain with a bond. It's often described as a fixed income instrument because of the features that I talked about before. We know we're going to make this loan over a stated period of time. We'll get periodic fixed coupon payments. There are exceptions. Some bonds pay floating rates, but most often they're fixed payments. And then at that predetermined amount of time, when the bond matures, we'll get our money back. And so, they play an important role in a client's portfolio. Can you talk about the increments
of a bond real quick before we get
What's that?
The increments of a bond and what you would usually find as far as $1,000 increments. And
Yeah. So going back to that example, like I was throwing out with Pepsi, Pepsi wants this, $50 million issue to raise capital for the bottling plant. They will be divided, for corporate bonds, it's typically in $1,000 increments. Other types of bonds could be much larger or smaller. It just depends on the type of bond. You look at like mortgage bonds or securitized bonds where they're trading, pools of mortgages or.
So if you have one bond for $1,000 and you get your money, you get your $1,000 back at the end of that term. You know what you're going to get, and in the meantime, you know the interest payments that you're going to get during that period of time. Mike, what happens when the Fed raises rates to those bonds?
Yeah, that's a great question. So, let's go back and talk about that Pepsi example. So they, issue these bonds, they're trading $1,000 increments, paying, 3%. If we go back to, a couple years ago when interest rates were lower, that's a pretty reasonable rate of interest that you could expect from a high quality bond from a company like Pepsi. So the 10 years until the bond matures, great. We're going to get 3% per year. We're going to get our $1,000 back at the end of 10 years. So we've got some certainty around that. However, if interest rates rise, let's say, Coca-Cola, a comparable company is paying next year due to interest rate increases instead of 3%, they're paying 6%. If we wanted to sell that bond that we own from Pepsi in the interim, right? Someone's going to say, hey, I'm not going to pay you $1,000 for that bond that's paying you $30 a year, 3% interest, when I can go get one from Coca-Cola that's paying twice that amount. And so what happens mechanically is that the price of the bond in the marketplace goes down so that the income, which is fixed, divided by the price of the bond equals what the prevailing interest rates at the time are. So when interest rates go up, bond prices go down. When interest rates go down, bond prices go up. It's an inverse relationship. That's the reason why that happens. The interesting thing is that we've seen a really sizable increase in interest rates in a very short amount of time. And so, last year was a historically bad year for bonds. I always like to say that typically a bad year for the bond market is equivalent to what you could expect for a bad day in the stock market. There's just not that much volatility more often than not. But the low level of starting rates back in 2022 and the rapid increase led to a sharp decline in bonds. The Barclays Aggregate Index, which is kind of like the S&P 500 for bonds, was down double-digit percentage return. So it was a historically bad year. In the last 30 years, to put this in perspective, that's the second negative year for bonds that we've seen over that time period. So it's a rare occurrence, but it can happen. The good news is that, your starting yield for bonds is typically, it's actually 94% correlated to what your, prospective return is based on the time horizon that you have for when those bonds are going to mature. So the good news for investors today is you can get attractive yields from bonds, corporate bonds. You can build a portfolio of investment grade, which, that investment grade refers to the credit rating for the bond. When you're dealing with bonds that are not issued by the U.S. government, which is backed by the full faith and taxing power of the citizens that live in this country, a corporate bond, there's a risk that we might not get our interest back if the company goes out of business. We might not even get our principal back. So today you can buy low credit risk bonds, a high likelihood of getting our interest and principal back that are paying north of 6.5%. And so if inflation, which today, based on the most recent June CPI report, is right at about 3%, inflation has come down, interest rates have come up, you're generating a real return, which is a return adjusting for the impact of inflation, north of 3 to 3.5%. You couldn't do that at any time in the last at least 15 years. So
last February it was
and not to get too far into the weeds, but the way we think about investing, there's really two important forces, and those are economic growth and inflation. And so I like to think about investing through the framework of you've got a quadrant. Economic growth is rising, economic growth is falling, inflation's rising, inflation's falling. We don't know where we're going to be in one of those quadrants, and so it's difficult to predict. That's one of the reasons why we diversify. But bonds typically perform best in an environment where we have abating inflation, or inflation is coming down, trending down. and or we have some combination of stable economic growth or declining economic growth. Fundamentally, this bond is an exchange of currency today for currency in the future. We know what that currency in the future is going to be. What we don't know is what inflation is going to do or what the economy is going to do. So if we see inflation coming down, that promise to get that currency in the future, that's worth more in that environment. Moreover, the certainty around the futures for a bond. We know when we're getting our money back. We know what kind of interest payments we're going to get and when we're going to get them. That becomes increasingly valuable as the economy deteriorates. And so, in that environment, that's kind of like the sweet spot for bonds. Well, I'm not, predicting any kind of an economic decline anytime soon. It could happen. But it does appear that, the inflation that we have experienced, which was substantial after the pandemic that we went through, has peaked, is trending down.
There's a couple of things there. To tie a bow on what is a bond, the longer term that you have the bond out for, so say it's a treasury at 27 years. If you don't get your money back for 27 years and rates have changed on you, the price of that bond is going to be much more volatile than a short-term bond of, say, a year, 2 or 3 years. So if you only have to wait a year to get your money back, the price of that bond is not going to move as much, is why you see large movements on the far end of that time horizon. We've answered a bunch of questions about Silicon Valley Bank, what happened there. They were basically backing up their depositors with long-term bonds, and rates went up, and what was backing up wasn't worth as much. It would have come back up if they had 27 years to wait, but they don't have that amount of time when they're have depositors' money. So we've talked about that a lot. You've probably heard us talk about that in your meetings. But longer-term bonds, more volatile. The flip side of that happens too. If we're at the top end of the cycle right now for raising rates, we get this question a lot: are we at the top? Well, we think we might have one left, maybe. It's already kind of built into the pricing. If they stay the same or they start to go down because we go through a recession at any given point in the future, and we know it's going to happen sometime, the first thing I got to do is lower those rates again. So what happens to the bonds? Well, rates go down, bonds go up. So you may be in a position where you're not only getting yield now, but you're also getting capital appreciation from those bonds coming up. So
even if rates don't fall, a lot of, like the example I was talking about earlier, where you can get a 6.5% expected, that's your interest rate that you're going to get, the yield that you're going to get from these bonds. The most of the bonds, due to the increase in interest rates, are trading below the value where they're going to mature. So there's some embedded capital appreciation there, attractive interest rates, and some upside if rates were to fall from here. That capital appreciation is accelerated even.
Bonds are sexy again.
Well, they're definitely interesting. And, another question that we commonly field right now is, hey, money market funds are paying really attractive rates of interest. Do we need to money market funds, essentially the mechanism where their interest rates reset is simultaneously what happens with short-term rates, which is heavily influenced by the Federal Reserve. So as the Federal Reserve is increased interest rates, short-term securities within these money market funds, you don't see any kind of a price decline. The relationship that you have with bonds moving inversely to interest rates doesn't exist with money markets. It's almost the opposite. The price stays stable, but the interest rate resets higher along with it. And so it's a good question. Do we need to be taking interest rate risk in bonds when we get 5.5% in money market? And, my thinking around that is, the risk with money market funds is what we would describe as reinvestment risk. It's the risk that if interest rates were to lower and you're holding a money market fund, your coupon payment with that is going to reset immediately with the lower interest rates that you're going to get. Over time, a bond, you're going to lock in the amount of interest that you're going to collect until maturity, and you're also going to participate in the upside from a price appreciation standpoint if rates decline. And so why I think money market funds it's fantastic that you can get a positive real return above inflation, leaving your money in a bank account or a money market fund. I do wonder 2 to 3 years out if people aren't, especially if they're over allocated to money market funds as a percentage of their total assets, going to look back with some regret that, they didn't take advantage of today's higher rates, investing some of their money in bonds to lock in those rates and participate in some price appreciation potential as a result of that as well. So,
Mike, you touched on the inflation coming back down to roughly 3% here. So we last year, if you'll recall, some of you bought I bonds based on conversations with us. You only put $10,000 in per person. They were at 9.5% when you put them in last May. Today, I just looked at my own. It's only paying 3%. So, I mean, advice for people currently with I bonds.
Yeah, I think I bonds can be a good portion of a portfolio over the long term. I mean, certainly there was that time frame where you could lock in high single digit returns on I bonds without taking any credit risk because they're issued by the United States government. That was kind of a no-brainer. Moving forward, 3%, it's still decent. It's definitely below what you're going to get from other high quality bonds. So to the extent that you're looking to reposition as time progresses, then I would look to maybe reallocate some of the capital that you have in I bonds, either to higher interest CDs if you're looking for something that's going to be very secure, FDIC insured, or even into bonds. The reason being is that this is just my personal opinion, but I think we're going to be in a time period where we're going to see more modest inflation. I don't think we're going to return to above 5% anytime soon. There's demographic reasons for that. I don't know if that's within the scope of the time frame that we have for this video today, but if we do move, to go back to that quadrant, those 4 areas that we could be in, to a time period where we start to see declining or stable inflation and stable or declining economic growth, that's where bonds are going to shine. And I think that's something to look forward to from a return standpoint. And if you think about an investment grade bond portfolio delivering a positive return over a 6 year, if your average maturity for bonds within an investment grade bond portfolio is 6 to 7 years, you're going to collect 6 to 6.5% coupon on that, plus get maybe 1% price appreciation per year. Your total return potential, total return, when you hear that term, means a combination of price appreciation and income is north of 7%. That's pretty darn good, especially for a lot of our clients when they're in retirement that can benefit from that stable income to fund their distributions. It's going to be pretty tough to beat from a predictability standpoint. You're not dealing with the whipsaws you could have anytime in the stock market. So that's bonds.
If you haven't watched it yet, we're at like 17 minutes. We want to keep these to 20, 22 minutes. So in the time that we have left, kind of just real quick, rising rates, the Fed raising rates, they're kind of waiting and seeing right now. They did raise rates just by 0.25 recently. We think there's probably one more of those left. I mean, anything you'd add to that to keep it simple? I mean,
predicting interest rates, good luck. If the last 24 months has not highlighted the unpredictability of interest rates, I don't know what would. However, I do think at this point in time, when you take a step back and look at where we are, in the economic cycle, where we are from the rate of interest that you can collect from bonds, this is the best time that we've had objectively to invest in bonds, at least in the last 15 years. You just didn't have this, combination of high rates of interest, real positive interest rates, meaning above the rate of inflation. You can double the rate of inflation with coupon from a bond today. You couldn't do that at any point in time. I mean, at least over the last 15 years. So while last year was a difficult year for bonds, this year, at least through the first half, the Barclays aggregate index was up, 3.25% approximately, on pace for a solid year. So I wouldn't let, recent history influence your thinking around, well, should I invest in bonds or not? I think now is an attractive time.
Today, Finch, the rating agency, lowered the U.S. Credit worthiness down to AA plus, I think it was, which really sent some impacts. I mean, not huge impacts, but that's what's happening today, trying to keep these, relevant to today. So as of August 2nd, 2023, how much does that matter in the world of, is my treasury bond safe?
Yeah, I think the downgrade's reflective of a reality that, we've seen increasing debt levels in the United States over a long period of time. Which is gonna, the more debt that you carry, there's greater risk that you might have some sort of a default. But within the sovereign bond market, when I say sovereign bond market, I mean, countries that are issuing debt with, this backed by the taxing power of that government. We're not operating in a vacuum. The United States has increased debt levels. So has Europe. So has China, Japan. This is, a situation where you might look at the United States almost as the cleanest dirty shirt, so to speak. I do believe, importantly, in the scope of what we would expect a treasury bond, the role that it would play in a portfolio in the event that we have a recession or some sort of a scare in the economy. There is a benefit to owning treasuries because there's what's called a flight to security. People panic. They sell different other types of investments to buy something that they believe is safe. Treasuries have fulfilled that role, played that role in our portfolios for a long time. In 2020, during the pandemic, from January 1st to mid-March, the bottoming of the stock market for that year, the treasury bonds we had in the portfolio were up 8 to 9%. And so it's an important diversifier. Again, it comes back to, if we have falling economic growth, falling inflation, bonds will do well. High quality bonds will do even better than low quality bonds. It's something that is an excellent diversifier. So while the Fitch downgrade, it's something to be aware of. The issues that we're having as far as increasing debt levels in the United States in the near term, and even over the next 5 to 10 years, I don't know that it's necessarily going to materialize into something like a default situation. Longer term, there's going to have to be some adjustments. Our debt levels in the United States, from today are north of $30 trillion, which does not count our promised but unfunded liabilities, such as Social Security, which is going to run out of money in early 2030 is what we're projecting. Other promised payments. So we're going to have to make some changes as a country. But I think defaulting on our debt is not something that's likely in the next decade.
All right, we got rapid fire. We got 30 seconds left. So yields in our top 3 portfolios: balanced growth and aggressive growth.
Yeah, so balanced, we have more income focus across real estate, bonds, equities. The yield is north of 5%. In our growth portfolios, it's roughly about 4%. In our aggressive growth portfolio, it's approximately about 2.75%. And so, in the aggressive growth portfolio, while the yield, the income divided by the amount that we have invested, is relatively low, we do expect high growth of income in that portfolio. If we didn't get high single digit, low double digit growth of income over the long term, that would be disappointing. So,
and lastly, oh my gosh, stocks have had such a good year so far. Should we trim? Should we get out? I know the answer, but what do you think, Mike?
Yeah. Anyone that's worked with us or invested with us for long periods of time would know that, we're not trying to time the stock market. Again, this year is a great example. We came into the year, this was the first year since 1999 that analysts collectively expected a downturn for the stock market. Earnings have been very stable, at least for the companies that we have your money invested in. We've had about 80 to, I think it's 80% of the earnings reports come in. They've been stellar, raising guidance. I can't think of a single report where I was like, okay, that's a little bit questionable, or the direction where their profits are heading is going in the wrong direction. So it's a situation where there's a lot of externalities we have no control over. You think about the last 5 years, what's gone on in the stock market. Good luck trying to predict, in 6 to 12 months where markets are going to go. But I feel very good about the way our clients' investments are positioned. The underlying fundamentals are extremely strong. If you didn't read our newsletter, take a look at it. This particular quarter, we focused on the balance sheet strength for the holdings that we have, the individual equity holdings that we have in the portfolio.
Yeah, we'll do another whole video on that maybe next time.
Yeah. That's, I don't want to.
We're gonna roll these out every other week, so we got a lot. If you know us, we like to talk. We could do this for an hour.
You get me all excited when I start talking about interest rates and balance sheets. I can't restrain myself.
So we'll cut that there. We appreciate you watching. If you stayed till the end, we're gonna do these every other week. So subscribe, get an alert when it comes out. And if we don't see you between now and then, we'll see you soon.